Hello and welcome to BQ Prime. You're watching Earnings with BQ, and my guest today is from Arvind Fashions, Kulin Lalbhai, Vice Chairman of the company. Kulin, thank you very much for joining us on BQ Prime. To begin with, a good set of numbers, good growth coming in the fourth quarter as well. 1140 crores. How are your power brands and the new emerging brands performing?
Generally, FY23 was a very, very strong year for us, where we added almost 1,300 crores of revenue. Of course, there was COVID in the base, but the company grew by 50% in revenue and 100% in EBITDA. So it was a very strong performance. And our company strategy is to focus on just our core 5, 6 large brands and scale them up. Our vision is that every single brand we have should eventually be 1,000 crores in turnover, as a minimum level of scale. So because we are investing in scaling up our existing brands, the benefit of that is that the operating leverage comes in and the profitability growth can be far higher than the revenue growth. And last year, we have seen all of our brands actually perform well and achieve this scaling up that I mentioned. And we are doing that by not only growing the core franchise, but also growing into new adjacencies like footwear, kidswear, innerwear. So those new adjacencies are growing very well for us and are helping scale these brands up to, a much larger level.
Kulin, I was going through a presentation and you mentioned, targets and what you've achieved in FY23. What is the kind of target that you have for FY24 in terms of top line and EBITDA?
See, generally, we don't give an annual guidance, but what we have shared with the market is that looking at all the growth drivers this business has from a medium term, say a 2, 3 year perspective, around a 15% growth rate is what this business should be able to achieve. We don't want to, push growth. We are focused on profitable growth. And hence, we believe 15% around that number is a very healthy kind of growth rate for this business. And we also have kind of guided the market that because this operating leverage will come in as the brands achieve scale and better sell-throughs and productivities, the EBITDA percentage of the business should go up by around 100 basis points or more than that every year.
Mm-hmm. Give me a sense of how much of that growth is going to come from existing stores and how much from new stores that you plan to put in?
So, stores are around 50% of our business. 25 is online and the remaining 25 is what we call distribution into department stores and multi-brand outlets. As far as that 50% is concerned, we will be opening around 200 stores next year, which is around a 15% expansion in the network that we currently have. Beyond that, of course, there is a like-for-like. I think like-for-like generally in a normal market condition is somewhere in the high single digits. So that's how one should think about the retail channel. Online, of course, tends to grow a little faster than offline, except for last year where there was a base correction. But, typically we believe in the medium term, online should grow at, say, somewhere around 20%. And then our distribution business, of course, grows in line with, more like from the LTL growth perspective.
And still you're guiding for a very conservative 15% growth?
I don't think it's very conservative. I think if it's a sum total of what I told you, it would come around that level. I mean, 2-3% up or down, in a medium term can happen. So you might have a year where it could be closer to 18-20% and certain years where it's closer to 15%.
What is the kind of investments that you're looking at when you're looking at opening 200 more stores in this current fiscal?
See, Arvind Fashions typically has a very asset-light model because we grow through the franchisee route. So the company does not invest in capex. We only invest in the inventory for the growth. So typically we have only had a capex plan of 60-70 crores. In the next year, in one of our businesses, which is Tommy Hilfiger, we will be taking over some stores and opening and converting them into company-owned, company-operated. So perhaps for next year, the capex will be slightly above 100 crores.
Okay. Give me a sense of how your adjacent categories are performing. You mentioned it briefly. What kind of investments are you putting in that category?
See, our most exciting growth category is footwear, which has already achieved, you know, it's scaling up very quickly. It grew more than 50% last year, and we are expecting again very high growth in that business. And what is very interesting is that US Polo has positioned itself very, very well on the casual sneaker side of things. It's a leading brand in the online space for sneakers. So we believe because of the strength of the US Polo brand. US Polo is now almost a 2,000 crore brand, one of the largest in the category. So it helps the new categories to really grow. So I think footwear is a big opportunity. We see it as, not in the very far away future. It could become 10% of the company's revenues, and it will build from there. And we also have kids wear and an innerwear business of scale. So all these adjacencies put together could over time become upwards of 20-25% of the overall Arvind Fashions turnover.
Any other new emerging areas that you're entering apart from footwear and kidwear?
The innerwear, as I mentioned, is an area we are in, and we also are in getting into accessories, which is an adjacency. So we already have a very strong accessories business in Tommy. We are now building it in US Polo. So our idea is to stay, in categories which are, very much within the purview of the brand. We don't want to go very far off, and it should be categories that help the brand resonate as a lifestyle brand rather than it being narrowly defined as just a apparel brand with a certain category. So these are all categories we believe will help the aura of the brands become much bigger and stronger in the years to come.
You've been focusing on premiumization as well. How's that taking shape? And give me a sense of how discretionary spends are also doing, because we've been seeing some kind of slowdown after Diwali. So how is both of them taking shape?
See, I think premiumization is a very strong kind of focus area for the company, especially for retail, because we believe that the retail stores are where the serious shoppers are coming and they are constantly looking for the next innovation, the next cool product that they can purchase and wear. And we have seen, a lot of price elasticity for, in some of our brands where customers are actually willing to pay a higher price for a better product. So in brands like Arrow and US Polo, almost our average transaction values have gone up by 400-500 rupees in our retail, because we are, giving these customers a much better product, and that is being accepted very well in the market, and we expect this trend to continue. Of course, there are more price sensitive channels and customer segments, which of course we cannot ignore. But there is enough of a customer base which is willing to and wanting to premiumize. So we will address that need in our brands. The question around market conditions, yes, markets have been sluggish post Diwali. Also, as we speak right now, if we compare to the previous year's base was a little higher because of the Omicron wave. So, last year, April, May were very, very strong months because people hadn't shopped in January and February, which is not the case this year. So, in that sense, there is a little growth moderation. Also, summer has been a little patchy as a season. There have been a lot of unseasonal rains across the country. So, a little bit of short-term, pressures on growth versus last year. But I think from a medium-term perspective, what I mentioned, I don't see any concerns in the India consumption story. I think the economy is doing well, and we believe that as festive approaches, there should be good spirits prevailing in the market.
Is it correct if I understand that Q1 is likely to be muted for you?
I think for everyone, there could be a little bit of impact of this base that I mentioned. But, we don't look at quarter wise in the business, nor do we give guidance quarter wise. But I think what we do plan for the next year is we have enough good growth drivers, as I mentioned, the store opening, the online growth, the adjacencies growth. So I think the company has good growth drivers for next year overall for the business.
Mm-hmm. How's discounting then? Because I think your margins expanded in this quarter in Q4, especially because you had a lower discounting. Given the fact that discretionary spends are slow, uh, do you see discounting to continue or the level of discounting to come down?
One of the big changes we have made in our business model is a lot of rigor and focus on what we call full price sell through, which is launching the seasons on time, ensuring the stores are presenting the merchandise perfectly, ensuring the aspiration value of the brand is there for people to want to come and buy the product at full price. So I think one of the reasons why last year our GPs have expanded and the business is doing very well is that full price rhythm, capability, and muscle has been built in the company. That being said, that in tough markets, there could be a slight drop in full price sell throughs that come through. It's too early to make those kind of assumptions right now, but there could be a slight impact of a higher EOSS and a slightly lower full price sell through, but too early to say.
Hmm. Kulin, we've seen some of your peers looking at tie-ups with fashion designers and joint stores which are coming up across cities. Are you looking at a similar model?
We are not actually. We have defined our core as being a very successful casual wear company. That is our strength. That is our core competency. We, of course, do have formal and a couple of adjacent categories, but our core is to, build these kind of brands with a lot of global appeal for casual wear or formal wear. So
Hmm.
right now, the company doesn't have any plans to get into ethnic or preth or all those kind of things. As I mentioned to you, our 3 year strategy is to really drive a lot of scale with our existing portfolio, derive operational efficiencies, push the return on capital employed in the business to strongly above 20%, and generate healthy cash flows. So for that, we do believe a focus on areas where there is strong core competency and scale is what we intend to do, rather than go after slightly diverse inorganic opportunities or anything like that.
Mhm. You had raised a rights issue of nearly 200 odd crores, which you used to pay some of the debts. Is there a requirement of further future capital as well?
No, the company is now in a very healthy position. All those things were there in COVID times when there were a lot of heavy cash losses that had happened because all the retail was shut down and all retailers went through heavy cash losses in those 2 years. So that was just to fix the balance sheet. But if you look at our balance sheet now, we've got a net debt of 400 crores. It's very, very comfortable. And the business is now, generating free cash flows. So there is no need for external capital, to fund the growth of the company.
Kulin, it was a pleasure talking to you today. Thank you very much for joining us on BQ Prime.
Great. Thank you so much. Pleasure being here.
Thank you very much.